In the third quarter of 2015, the Kellogg Company actually expanded its core business. They sold more cereal, moved more snacks, and successfully improved their global operating margins. This chart tracks their earnings per share for that quarter. On a currency-neutral basis, actual operational growth drove earnings up 2%, represented by this green line hitting 96 cents. But their officially reported earnings went the exact opposite direction. They dropped 10%, landing at 85 cents. That 11-cent delta has nothing to do with manufacturing costs or consumer demand. It represents revenue completely erased by the strength of the US dollar against foreign currencies during that exact financial quarter. Global macroeconomic volatility attacks raw revenue regardless of how efficiently a company operates on the ground. You can optimize your supply chain to the penny, and a sudden swing in foreign exchange rates can still wipe out a quarter's operational gains. In corporate finance, this vulnerability is called exposure. It is a mathematical problem, and a multinational treasury department exists specifically to isolate and contain it. Evaluating a corporation's true worth requires looking past the final balance sheet. You have to separate their actual operational skill from the chaos of unmanaged currency fluctuations. This diagram illustrates the three structural pillars of enterprise currency risk: translation exposure, economic exposure, and transaction exposure. To protect immediate cash flow, treasurers isolate one specific pillar: transaction exposure. This is the financial risk that materializes in the delay between the moment a contract is signed and the moment the invoice is finally settled in a different currency. If a company ignores the risk hiding inside that 30, 60, or 90-day delay, they are effectively placing an unhedged bet on global currency markets. The Treasury Department becomes a speculative participant in a market outside its core business. Securing that capital does not start with purchasing complex financial derivatives. It starts with mathematics. Treasurers must first calculate the precise boundaries of that unknown future settlement. Let's look at a textbook example of quantifying this risk. A Swiss travel company expects a $2.5 million receivable from U.S. customers, but they also owe $1.5 million to U.S. suppliers. Both will settle in exactly 30 days. The firm applies a technique called netting. Since both transactions occur in the same currency during the same window, the payable offsets the receivable. The true operational risk is isolated to exactly $1 million US. The Swiss firm only cares about the value of that $1 million in Swiss francs. Because exchange rates fluctuate constantly, they need to bound the 30-day downside risk. The simplest way to do this is to look for historical extremes. We are looking at a descriptive statistics table covering 20 years of monthly exchange rates for the Swiss franc to US dollar. Over 2 decades, the absolute best month saw a 15% gain. The worst single month recorded an 11.62% drop. If the Treasury assumes that worst-case scenario will repeat exactly, they multiply that 11.62% drop against the current spot rate. This establishes a capital floor. The company would receive 1.281 million Swiss francs. The math works, but the strategy is highly inefficient. Preparing for a once-in-20 years economic crisis on a rolling 30-day basis means the firm must freeze vast amounts of operational capital just in case the absolute worst occurs. Capital is oxygen for a business. Efficient risk management requires calculating probability distributions to map realistic outcomes, rather than blindly bracing for historical anomalies. To find a realistic capital floor, treasuries deploy a method called historical simulation. This builds a forecast for the upcoming 30-day Saugnig window based on empirical data. The mechanism relies on volume. The system pulls thousands of random, historical monthly exchange rate changes and applies them to today's current rate to simulate thousands of potential future realities. As this histogram builds, those 1,000 isolated scenarios group together, revealing a probability distribution of what the exchange rate is most likely to do over the next month. Risk managers extract value from this raw data by establishing a 95% confidence interval. They draw a threshold line cutting off the bottom 5% of worst-case outcomes. The simulation dictates that this threshold sits at 1.366 million Swiss francs. This is actionable intelligence. The Treasury now knows with 95% mathematical certainty the minimum amount of home currency they will receive based on past market behavior. Compare that 1.366 million threshold to the 1.281 million naive extreme we calculated earlier. By using probability instead of historical worst cases, the firm safely frees up tens of thousands of francs for immediate operational use. But historical simulation is strictly backward-looking. It relies on the assumption that future volatility will stay within the bounds of historical patterns. To map the true dimensions of future risk, treasuries have to leave raw historical data behind and translate those observations into a forward-looking parametric mathematical model. This is the visual representation of parametric value at risk, or VAR. It is a standard model that relies on the assumption that currency markets follow a normal distribution. Because it is a smooth bell curve, risk managers can apply standard deviation formulas to pinpoint exact confidence intervals without running thousands of manual simulations. Using this formula, the expected maximal loss, the VAR, resolves to negative 0.092 million Swiss francs. It is an elegant, efficient mathematical shortcut, but it only works if you believe financial markets behave normally. They rarely do. Sudden macroeconomic shocks, complex geopolitical conflicts, and systemic liquidity crunches frequently shatter standard normalcy assumptions. If we look back at the actual dataset, we find the mathematical anomalies that break the parametric VAR model. Notice the distinct values for skewness and, crucially, kurtosis. In statistics, excess kurtosis indicates fat tails. In reality, it means extreme outlier market events happen more frequently than a perfect normal curve predicts. This empirical reality distorts our probability model. The center drops and the tails stretch outward, carrying a higher concentration of extreme risk. To fix the model, quantitative analysts apply the Cornish-Fisher expansion. This adjusts the standard z-score, mathematically forcing the model to account for the skewness and the fat tails hidden in the data. Accounting for fat tail behavior allows a treasury to model for the events that a standard normal curve dismisses as impossible. It replaces an idealized assumption with a model that acknowledges the actual volatility of the global market. Quantification is the diagnostic phase. Once the exact capital at risk is mathematically modeled, the treasury must execute financial derivatives to neutralize it. A common misunderstanding of hedging is that it exists to beat the market or capture the best possible exchange rate. If that were the case, treasuries would operate as profit centers rather than risk management units. The true structural objective of a hedge is predictability. The goal is to protect operating margins and ensure cash flow consistency over multiple quarters. A jagged line tracks the volatility of unhedged spot rates. The stable step line shows the outcome of a mature hedging program. This stabilization isolates the company's core product margins. When the underlying currency market drops, the hedged revenue remains at its forecasted level. Treasury management systems achieve this by layering specific instruments over the risk: forward contracts to lock in rates, currency options for downside protection, and cross-currency swaps for long-term debt. Executing these derivatives is effectively purchasing time. The Treasury buys a stable buffer zone, allowing the core business to adapt to new macroeconomic realities without taking a sudden, massive hit to its cash flow. Zooming out from a single invoice, we see how these instruments function at a macro level. Tools like cross-currency swaps allow institutions to bypass physical or regulatory limitations on their capital. The template for this synthetic architecture was established in 1981 through a pioneering swap executed between IBM and the World Bank. The World Bank needed to diversify its borrowing to avoid depending on any single market. However, they had hit regulatory limits in specific European currencies, effectively locking them out of vital, low-cost funds. The solution was synthetic. The World Bank swapped its US dollar debt for IBM's Deutschmark and Swiss franc debt. By treating their exposures, they bypassed the regulatory wall entirely. That single transaction established the blueprint for a derivatives market that now handles hundreds of trillions of dollars in notional value. The 1981 swap proved that constraints of a single market or regulatory jurisdiction are not absolute. By combining statistical quantification with synthetic architecture, institutions can navigate volatility and access liquidity that was once physically out of reach.